The home value index is out today, shows a minor increase of 0.3% for the capital cities around Australia, which doesn't seem like a great big deal. But I'm joined by CoreLogic RP data researcher Cameron Cusher. Hello, Cameron. Is that a surprisingly low amount considering we've had a recent interest rate cut?
Well, I think what you'll find is that the interest rate cuts will take a little while to flow through into the data. Obviously, we know that the auction markets have been very strong ever since those interest rate cuts at the start of the month. But I guess it's a bit of a pullback from what we saw in January. But looking at the trend, in terms of the annual rate of growth, it reached a low point of 7.9% on an annual basis in December of last year and is now inflating a little bit again up to 8.3%. So definitely some heat coming back into the market, and with the recent interest rate cut, probably over the next couple of months you'll start to see the impact of that, and I think again it'll be very much a Sydney and Melbourne centric impact on the housing market.
And some of those issues must be weighing on the Reserve Bank now that they might consider cutting rates again tomorrow. What would happen if they did do that?
Well, I think, as I said, what we've seen ever since the last interest rate cut at the start of the month, we've seen auction clearance rates really rebound very strongly in Sydney and Melbourne, and lift in the other capital cities as well. But Sydney's been above 80% for 4 consecutive weeks. Melbourne's moved from the low 70s to the high 70s in terms of the percentage clearance rate. And I think if we did get another cut, it's just going to create more confidence in that housing market. You're not going to get any money keeping your money in the bank. So investors are looking for alternatives where they can get better returns, and obviously the housing market, and to a lesser degree obviously the share market's offering that at the moment.
And can you give us a little bit of colour around the prices in the growth rather in prices in Sydney, Melbourne and Brisbane, because they're traditionally the stronger cities, but it seems that this time Sydney has recorded a pretty good growth rate for February, but the others not so much.
No, so Sydney home values increased by more than 1% in February. In Melbourne we saw just under 0.5% growth, and in Brisbane we saw a 0.3% fall in values over February. But if we look over the longer 12-month period, Sydney home values are up more than 13%, Melbourne around 7.5%, and Brisbane just over 5.5%. They're the three strongest performing capital cities, and most other capital cities have seen growth of less than 4%. So it's really a Sydney, then a big distance back to Melbourne, and then a distance back to Brisbane, and then the rest of the markets really aren't seeing much in the way of capital growth at the moment. So, and there's some reasons for that. If we have a look at demographics, they're very favourable in New South Wales and Victoria. Less people leaving the state, a lot of overseas migrants settling here, a lot more jobs being created in these states as well. And that's really, I think, more so than just purely an interest rate story, what's driving the markets.
Do you do any granular analysis about where in, say, Brisbane, Sydney or Melbourne is recording the big price growths, and if there are places where there really isn't very much growth or very much momentum or even a decline?
We do look at it. We haven't got the latest information for this month, but if you look across Sydney and Melbourne, it's pretty much an holistic increase in values across the city that we're seeing in both of those markets. Certain pockets are obviously much stronger, so the inner west in Sydney is quite strong. Areas like Blacktown and Fairfield are also quite strong in Sydney. In Melbourne, really every area is recording quite strong growth except for the Mornington Peninsula area. And then if we go to Brisbane, you're finding that the Brisbane Council area, which is much bigger than the council areas in Sydney and Melbourne, which is really 10 to 15 kilometre radius of the CBD centre, is very strong. The overall performance is being dragged down by those areas on the outskirts of the city like Ipswich and Logan City and these sort of places.
And what's the story in Perth? I noticed a big drop, 2.2% for the month.
The Perth housing market's really decelerated quite rapidly over the last year. We're still seeing rates, values increasing. So over the last 12 months, they're up 1.9%. But 12, 18 months ago, we were seeing 10% annual growth in that market. And I think what we're really starting to see is the impact of the big drop in iron ore prices. Obviously, the West Australian economy is very resources focused, and that's coming back to hurt the market. We're also seeing rental rates fall. We're seeing more stock on the market than at the same time last year. And we're also seeing a record number of building approvals as well. So there's a lot more supply coming onto the market. So I think that over the next 12 months, the Perth market's going to continue to weaken.
Just one last thing, Cameron. What did the CoreLogic team make of the the proposal around the foreign investors, the $5,000 or more, say, in service fee or tax or whatever else you might want to call it?
Look, we don't think that it's going to be too much of an impact on demand. As a proportion of what these people are paying for brand new homes, it's minor. It's about 0.7% of a $600,000 home. So it's only a small drop in the ocean. And I think if it allows the Foreign Investment Review Board to actually do their job properly and funds them to actually start surveilling who's buying, where they're buying, and making sure they're doing it properly, it's a good thing. And ultimately, in order to fund that bureau, it either needs to be from our taxes or from this sort of fee. And I think some of the talk that this fee is going to be detrimental to the market is pretty wide of the mark.
Well, Cameron Cusher, thank you very much.
Thanks, Kyla.